This is it. I'm telling you, this is it.
What is going on YouTube? It's Brendan from Market Makers. A special video for you today, my friends. The price action's pretty flat. Market's still looking to make their top, still waiting on a Bitcoin move. So I want to focus on where these markets are going. I think it's an important video all of you need to see. It's so important that the chairman from Market Makers is helicoptering in from his private yacht, and he has a special message for you before we kick this off. Mr. Chairman.
Welcome, everyone. I must apologize for dragging you all here at such an uncommon hour, but from what I've been told, this matter needs to be dealt with urgently. So urgently, in fact, probably should have been addressed weeks ago, but that is spilt milk under the bridge. So, why doesn't somebody tell me what they think is going on here?
All right. I will do my best to explain it. Let's get into this, guys. Michael Burry from the movie The Big Short. Well, actually, The Big Short was made about Michael Burry. Michael Burry, this is him here in the photo. He shorted the '08 bubble, the housing market bubble, which is how he became famous, but he also shorted the dot-com bubble. He also was involved in the GameStop meme stock and made millions of dollars there as well. He's a very savvy reader of the markets, okay? So he understands what's happening in the marketplace. Now, he made news, this is from yesterday, because Q2, he had to file what he did with his hedge fund, dumped all his stocks except one little company, which is a private prison company in Florida, one that I hope I never end up in, but that's what he kept. So this is important for people that follow market forecasting, because Michael Burry, again, is a very well-established, very successful reader of the marketplaces, in line there with Grantham and with Dalio, okay? Michael Burry believes, he sent out some tweets. He deletes his tweets very quickly after he sends them out, but he has a very strong following. He believes after this rally dies, we're looking at the next leg down. So let's go ahead and focus on this and see what's happening, guys. What do I see in my crystal ball in these marketplaces? Guys, I'm going to try to explain this to keep this really simple so it's not confusing. Excuse me, sir?
Speak as you might to a young child or a golden retriever.
I'm sure you don't have to be a golden retriever to understand this. So I will make it very clear that even a golden retriever could understand it. Guys, let's go over the simple concept here of what bubbles are and why we are in a bubble and why this is so catastrophic for the country. So we have a history of bubbles in the last 20 years in this country. We have the dot-com bubble. It's an equities bubble. Didn't involve real estate. Didn't involve bonds. Didn't involve crypto. So that equities bubble caused the market, the S&P, to get cut in half. It went down by 50%. Again, remember, key Dow retracement, key Gann retracement, the most important retracement in the market. 50% down on the S&P, 82% down on the Nasdaq. This bubble we are in now, from an equity standpoint, extremely similar to the dot-com bubble, led by tech, led by parabolic runs up. So we're going to look at that in a second. Now, understand the '08 bubble was a housing bubble that was intertwined with the investment banks because of subprime mortgages and things like that. But once again, what did the S&P do? It went down by 50%. That number repeats itself. So we're going to look at those targets of where the S&P can get to. And you have to understand where we're trading now. This is the first multi-prong bubble this country has ever had. So we had these individual bubbles, housing bubble, equities bubble. We now have an equities bubble, a housing bubble, because now homes are selling at a higher multiple of median household income than they did in the actual housing bubble itself. So you have a two-prong bubble there. You had a crypto bubble, arguably. You have a bond bubble, and you have a bubble in certain commodities as well. Guys, this is a multi-pronged bubble, and this can be really catastrophic. The only comparison I can give you is 1989 Japan. Jeremy Grantham talks about this extensively because he was involved in making a lot of money in that bubble. 1989 Japan, they had an equities bubble and a housing bubble. To this day, here we are in 2022, that bubble that happened in Japan, those two markets have not reached their previous all-time high. People don't seem to understand how long markets can stay suppressed and not reach an all-time high after you have these 3 sigma bubbles. Sigmas are deviations, guys. 3 sigmas are 3 standard deviations away from long-term trend. After the great crash in 1929, you did not get a new all-time high till the mid-1950s. After the dot-com equities crash, it took 15 years to get the Nasdaq up to a new all-time high. So we need to look at this and understand the marketplace we are trading in, okay? Understand the Fed caused parabolic rises in all these assets by printing trillions of dollars, more money printing than all of the Western world combined. So let's look at this, because this did give you, a lot of people in crypto don't think you got to blow off top. You most certainly got to blow off top, and you're going to see it a lot easier in equities. But from the pandemic low, guys, up to your all-time high, you went up almost 1,700%. That's a blow off top, okay? So let's look at this. If we take a trend-based fib from the previous all-time high to that previous market low to the current all-time high, you get phi, guys. I've been talking about this since November last year. 1618 at 10,591. Now, this would make sense in Fibonacci. This doesn't make sense in the macro scale of things. You're trading at 23,805 at the moment. Trust me when I say if the S&P gets cut in half, it's only minus 10% right now. If it gets cut in half, you're going sub 10K Bitcoin. And again, you're going to come down and test your long-term trend. See your 200, 233 moving average. You're going to come down and test your long-term trend, which was down here in the in the pandemic lows. I personally have a target of Bitcoin at 3,800, okay? Let's go ahead and jump over to the S&P. S&P, guys, as we've been talking about, we look to be making our market top here at the 200. I do anticipate, even if we get overspill, just like this, above your 200, you're going to make a shape and come back down for this next leg, okay? That next leg down, and we may very well end up retesting those June lows. But where can the S&P actually get to if this continued decline occurs? Let's look on the weekly. Now, guys, remember, this is a consumer-led recession that we are going into, and it is grinding. The Fed has to continue to raise rates. It's well below the actual inflation rate right now of 8.5. They have to continue to raise rates, try to destroy demand, try to hope that a large portion of this inflation is due to supply chain, which it is not. Inflation is always and everywhere a monetary phenomenon. The great Milton Friedman, who would know, because he dealt with this all in the 70s and 80s and helped conquer it with Ronald Reagan and Paul Volcker in the early 80s. Okay, so this is a monetary phenomenon from printing trillions of dollars. We have the Fed going to do quantitative tightening, raising rates. We're going to have, after this next rate hike, the highest rates we have had in decades. I don't think the market will be able to hold on too long before it actually capitulates with these higher rate hikes. So this is something that you guys need to be very well aware of, which is why we want to look at key retracement targets for these marketplaces. And of course, watch this channel to stay tuned to actually track the movements as well. Guys, let's just do what the S&P has historically done twice now in the last 2 bubbles. The S&P dropped 50%. So when I keep telling people you're going back to your pandemic lows and people say, you're crazy, you'll never get there. Look where 50% gets you. 50% gets you 2,400 on the S&P. 2,400. Now, is that number made up? No, we've done it twice in the last 20 years, guys. It gets you back to 2,400 on the S&P. If you go down that low, crypto's definitely going to get crushed as well. Now, a couple of things I want you guys to understand. You guys all know we have these equity guys that do nothing but, I can't use that word, but just say really negative things about Bitcoin, right? They say negative things about crypto. It's all speculation. It's all garbage. You can't make any money. It's based on greater fool theory. Yeah, I get that. And hey, you can say it's a valid opinion, but I'm here to trade and make money. What I want you guys to understand about speculation, that knife cuts both ways. If you look at the S&P here from the pandemic low, up to its all-time high, a 121.18% gain. The S&P, since we started doing all of the Fed easing after the 08 financial crisis, we now returns about 10, 11% a year, okay? So just that's since the easing has started, since 08. So you're looking at 11%, let's just say 10% return. You 6x'd a 2-year return in the S&P. This is the Fed pump, guys. This is trillions in liquidity into the marketplace. This is Peloton. This is meme stocks. Think Cathie Wood's ARC, all these garbage companies, high growth that make no money, that had exponential multi-hundred price to earnings ratios. Okay, that is speculation. So pot, meet kettle, because don't call crypto all garbage when the same exact speculation takes place in stocks. Nobody, if you look at the semiconductor space, no company is worth multiple hundreds price to earnings. That is speculation. That is how you get parabolic rises, a rise that will capitulate and fall back down. Okay, so just be aware of this. This normally would be a number here would say 21% or 22%, not 121%. That is absolutely mental. And you need to understand that if you're not involved in equities, this is a parabolic run. This is not strength of the economy. This is the liquidity forcefully being injected into the marketplace. Trillions upon trillions being printed. The Fed now carrying a $9 trillion balance sheet. Nasdaq, guys, Nasdaq on the daily. Again, we're still below the 200. Could get some topping action before the 200 or get just above the 200. We'll have to see how that plays out. But again, you can have overflow or just start getting rejected at the 200. Looking at the Nasdaq on the weekly, if we do a fib wave projection, guys, from this double bottom that we're trading on that chameleon, right? The double bottom here, fib wave projection. Let's just take the Nasdaq. So we know the Nasdaq went down 82% in the equities bubble, 82%. But let's just say, for the sake of argument, let's stick with 50 and 66%, okay? Because people will say, well, the Nasdaq will never go down 82% again. There's a lot of garbage companies. Really? Back in the .com? Yeah, there were. There were pet.com, things like that. Plenty of garbage companies now, but for the sake of argument, let's just say we match, which the Nasdaq doesn't do. It will go down more, okay? It will go down more than the S&P, but let's just say we match that 50%. That first 50% retracement would get you down just underneath that 2618 there in that fib wave projection. So you're looking at 8,366 on the Nasdaq. And you're trading at 13,625. Look where else this does. This gets you to the mid-range of your pandemic low, okay? Now let's use a Dow number, 66%, because I think the Nasdaq's going down 61.8, which would be a Fibonacci number. That gets you down to almost 6,400, and 66% being the Dow retracement number gets you down to 5,600, okay? And if you look at that, what does that line up perfectly with? The 4236 Fibonacci number, trend-based fib, 66.45, gets you to 5618. And again, that is below long-term trend, below the pandemic low, but there's a lot of garbage companies. Remember, the Nasdaq's heavily weighted with the top 5 companies. So a lot of garbage companies. If the S&P does go down 50%, I'm looking for at least a 61.8 to 66% retracement in the Nasdaq, guys. And there's doomsday guys that have much bigger numbers, 90%, 95%. And there's moderate guys that's saying, oh, we're just going to go down maybe 50%. This is what I think is going to happen with my view on the marketplace. Very important concepts, guys. I just want you guys to understand where you're trading. The Fed doesn't care about you. In 08, the Fed stepped in, and .com, the Fed stepped in to try to save the markets. The reason they are trying to do a soft landing engineer is because they want to protect the top 10% of the country. If you're looking at the elite, the top 10% own 90% of the equities. So if you think Bill Gates, if you think Powell, if you think Biden, if you think Janet Yellen really care about inflation, they don't, okay? They care about protecting the elite, the donor class. That's the structure of our feudal country that we live in. They don't care about you. This is why the Fed, by the way, is not doing a Paul Volcker. This is why Powell won't raise rates to 10%. He could raise rates to 10%. It would crash the market, maybe by 50%, just like what Volcker had to do. Volcker raised rates to 20% to conquer 13.5% inflation. He did that knowing it would crash the market, but guess what? Parabolic recovery in the marketplace, long-term bull run, and you crushed inflation. This soft landing narrative is designed to help the elite, guys. It's not designed to help you. It's not bringing down food prices accelerating at a 43-year high. It's not bringing down other commodity prices. It's not bringing down the price of clothing, the price of housing. This is designed to protect the wealthy. This is the system that we live in. It is a class-based system, the haves and have-nots. So everybody needs to look out for each other, educate your neighbor, let people understand what's happening. I don't get overly political on this show, but it matters who you vote for, guys. When people go on TV representing the government and they say things like 0% inflation, or we're not in a recession, or just go buy an EV, you don't have to worry about gas. Well, the average American family makes $38,000, $40,000 a year. They can't go buy a $75,000 Tesla. Sorry, some of us actually have to buy gas. Some of us don't have access to charging stations. Some of us like the vehicles we drive. This is an elitist attitude, and it's very prevalent in the elite in our country, the millionaires and billionaires, and particularly in the political class, guys. So look out for each other, educate each other, and stay tuned for more videos. Hope you guys enjoyed this one. I'll answer your comments and questions below. Talk soon, everybody.